Hello and welcome to episode 11 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria. I'm currently a student at the University of California, Los Angeles, but I'm actually home for spring break. And since this is our 11th episode after all, we decided we're going to change things up a little bit, try to make it a little bit more conversational, less scripted, so let's see how that goes.
This week, we will briefly discuss a potential deal for the fashion company Guess, a new twist to Danone's bid for Lifeway Foods, QXO finally getting its way and acquiring Beacon Roofing Supply, the spinoff of Comcast's media assets, a buyback announcement at an avocado grower, and Tencent Music, a big insider sale of Apollo Global Management by its co-founder Leon Black, and a whole lot more.
Now, I did just say we're going to be a little bit less scripted, but as per usual, the disclaimer is going to be our standard one. So before we begin, it is important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.
So let's get this episode started with M&A activity and specifically deals in the works or potential deals that haven't been confirmed just yet. So guess what? The first deal we want to talk about is Guess, which received an offer for $13 per share from WHP Global.
And for our viewers who don't know, what exactly is WHP Global?
I was looking them up and it's actually quite a fascinating company. They own a motley crew collection of 14 brands, including Toys R Us, Babies R Us, Anne Klein, Isaac Mizrahi, Express, Joseph Abboud, and these brands generate $7 billion in annual sales for them. I remember Isaac Mizrahi, you're probably too young to remember this, but that was this big splash he had created when he partnered with Target to bring his products to their stores. I haven't heard his name in years, but then again, I don't know much about fashion, so maybe others might still find that brand interesting.
But actually, I wanted to ask real quick, Toys R Us and Babies R Us, didn't they go bankrupt? So are they really contributing to that $7 billion of sales generating? How's that work?
Yeah, so it's actually interesting. There are some companies that end up buying these brands in bankruptcy, and they might not have all the stores, but they might have an online presence, and they try to capitalize on the brand that was already built and the value that was created. So I think this might be similar in that sense. They might take guests and maybe slow down some of their mall expansion or even scale it back, and then use a brand on omni-channel or e-commerce to try to generate more sales.
It's definitely interesting for sure. And moving back to Guess in that sense, the stock jumped from $9.70 to $12.62, but has since come down and is just below about $12 right now. So very much below that $13 price that the deal was offered at. And the other part that's interesting here is that the two co-founders of Guess are willing to roll over their shares instead of taking that $13 per share buyout. The CEO, Carlos Alberini, is also rolling over his shares.
So considering they are all rolling over the shares, I find it surprising that the stock is trading so much below that $13 buyout price. So I was looking them up and I didn't realize that Carlos Alberini used to be the co-CEO of Restoration Hardware, which is now known as RH. The two Marciano brothers who co-founded Guess own 47% of the company, and Alberini owns a little more than 3%, which means together the three of them own more than 50% of the company, but they still need the rest of the shareholders to get aboard this $13 offer.
Now, Guess's stock is down nearly 60% over the last year, despite that recent pop after the WHP Global offer. It might be hard to convince these other shareholders we were talking about to vote for the deal unless the offer is sweetened. Over the last 5 years, though, Guess is still up about 90%, but some of that is because we are now comparing prices from pandemic lows, So everything over 5 years looks pretty impressive.
Yeah, we need to start looking at 10-year charts to understand what's happening to the price instead of the 5 year going forward. The business is surprisingly still growing double digits, even though they missed estimates on both revenue and earnings. So when I see a brand like Guess and I see double digits revenue growth, I often wonder that if it is because of a recent acquisition, and that was exactly the case here. They did not grow organically, and that double digit growth was related to the acquisition of Rag and Bone, a clothing and shoe fashion brand, I think that is based in New York. The interesting thing about Rag and Bone's acquisition is that Guess actually partnered with WHP Global for the acquisition. So now you begin to start to see why it is that WHP Global might be interested in Guess, because they already are familiar with working with them on a prior acquisition. For the full year, they took down both the revenue growth and profit estimates. And now they expect to earn somewhere between $1.85 and $2 a share, compared to an earlier estimate of $2.42 per share to $2.70 per share. So, quite a bit of a downturn there, if you will, in terms of their forecast. The stock seems to be cheap, and I can see why management wants to take it private.
So moving away from gas, last week we talked about TXNM Energy, which is a utility that provides electricity to, as you might expect, Texas and New Mexico, and was actually previously known as PNM Resources. The company indicated that it is exploring a sale after receiving takeover interest from a potential suitor, and according to Bloomberg, that potential suitor might be KKR, one of the world's largest private equity firms.
Yeah, so last week we mentioned that PNM Resources may be recognized by some merger arb investors because Avangrid announced an 8 billion acquisition for PNM Resources in October 2020, but that deal failed in January 2024 due to the New Mexico Public Regulations Commission, that's a mouthful, voting to reject the deal. So it might be easier for someone like KKR to close this deal compared to Avangrid. KKR's stock, along with other PE firms, is down a lot this year, but it's still up a lot over the last 5 years.
Right. In addition to how maybe the deal will get approval quicker, hopefully it'll close quicker as well, because that Avangrid possible acquisition was definitely one of the longer term and longer time period ones we saw, right? October 2022, January 2024.
Indeed. The only other one that I remember going that long was Genworth Financial, the insurance company, and that deal eventually failed.
Exactly. So long time period might not bode as well, unless the companies are really willing to fight for it. Speaking of fighting when it comes to M&A deals, actually, Zentree Investments has about a 13% stake in 23andMe and decided it doesn't want the company to sell at an unreasonable price. In prior podcast episodes, we've talked a lot about the CEO Anne Wojcicki of 23andMe offering to buy the company.
Yeah, so it's interesting to see that she came up with a final offer that was $2 and change. I think it was $2.53, if I'm remembering correctly. And then she had a bunch of CVRs attached to that deal as well. So this is quite a roller coaster, tiny microcap situation that in some sense is probably best to stay away from, but it's fascinating to see how it'll eventually play out. The other potential acquisition that's interesting is the family feud for Lifeway Foods and the potential acquisition by Danone, the French company. The current CEO, Julie Smolansky's brother, Edward Smolansky, is trying to shake up the board of directors at the 2025 annual meeting. He nominated George Sent, who was a former chair of Lifeway's Audit and Corporate Governance Committee, himself, and Ludmila Smolansky, who is his mom and holds a significant stake in the company along with him.
So the three of them, in connection with this move, stated, and I'm reading this verbatim, instead of negotiating better terms with Danone and or mending fences with its largest single shareholder, we find Lifeway Foods having to contend with litigation stemming from clearly questionable conduct. Importantly, the timing and magnitude of the $8.5 million aggregate CEO award in cash and shares, equating to about 94% of Lifeway Foods' 2024 net income, suggests that this board is far more interested in enriching the CEO than maximizing value for all shareholders. So that's a pretty big statement, pretty big claim that they're making. And it makes sense why they want to shake up the board in that sense. but they're gonna have to go ahead and prove it if they eventually become successful or in their bid to join the board.
Indeed. And maybe at that point, Danone's, I think, $27 per share cash offer might go through. So, to wrap up our potential deals this week, according to Bloomberg, the private equity firm Clear Lake Capital Group is nearly reaching an acquisition of Dun& and Bradstreet for $9 per share in a deal that would value one of Wall Street's oldest data and analytics provider at about $4 billion. So the stock was below $8 a few days ago, and it's currently trading at $8.73 per share.
Moving on to some current deal updates. The First Financial Northwest liquidation is expected to complete on April 11th, 2025, and the money is to be returned to shareholders in multiple distributions, with the initial distribution expected to occur as soon as possible after the completion of the transaction. It's nice to see this FFNW transaction finally come through. I personally am a shareholder of the company, so it'll be interesting to see the transaction finally close out and come through.
Yeah, we're talking about the First Financial Northwest acquisition of a bank by a credit union, which was unusual. The fact that this took so much longer than we expected was also unusual. But then again, time and time again, we find that bank deals and insurance deals just take a long time to complete. The other interesting thing that we saw on announced M&A was Wakasa accepting Kasago's higher offer, but the deal is still trading at a negative spread because they have an even higher offer from a third party that they decided not to accept. All of this is very confusing. The Wakasa and the Kasago, all of them having the word casa in their names, which, as in in Spanish means home. And I remember this quite well because you used to see billboards all over the Bay Area about this fractional home ownership model that Wakasa and Kasago offered to people. So instead of buying a property and renting it out on Airbnb, you and 7 other people could own one property together and choose to stay in it for a few weeks each year.
Is this similar to the timeshares they put you through at some of the hotels or the presentations for those, or is it different?
It's a little bit different. I certainly wouldn't go anywhere near a timeshare, but I didn't look at this close enough to know how similar it might be or how different. It seemed like it was less of a hassle than a timeshare these days seems to represent.
I see. Okay. So maybe somewhere in the middle ground there. Moving on to new M&A, though, there were 3 new deals announced last week, and the one that generated the most interest, especially from us, was QXO finally winning the deal for Beacon at $124.35 per share in cash. It's $11 billion total value for the deal, including debt. Brad Jacobs was very much celebrated on LinkedIn after this deal. And honestly, so were we. How long have we been talking about this deal on the podcast for?
I think we started talking about it in episode 4, and we've been discussing it continuously for 5 episodes in a row. So maybe we are equally happy that the deal has come through. We had it in the model portfolio. And the deal was unusual, if you remember, because they went out and got regulatory approvals even before a deal was struck. So that part was interesting. They then went to shareholders directly and said, we are starting off a tender offer because the board is not engaging with us. He just seems to be a force of nature that wants to make the deal happen. And so the next time we see Brad Jacobs or QXO, trying to buy a company, we'll probably be paying attention once again.
All the force of nature, though, I will say, not that many shares comparatively were tendered in the tender offer. This deal eventually went through because Brad Jacobs was able to collaborate with the board of Beacon. And more importantly, the deal wasn't that much more than the original offer. I think the final offer was $124.35 per share in cash, whereas the original offer was just 10 cents below per share. So, not that much of a change, but I guess it was enough of a change to push the Beacon board to finally accept this deal.
You're right. I think it was 18% of shareholders had tendered their shares. They were probably holding out thinking that the board will be able to negotiate a higher offer. They were partially right. They got about 10 cents more, and that explains why they didn't fully tender those shares.
Makes sense. But for those who were hoping to get maybe like $2 or $3 on top of it, out of luck in that aspect. Might have been better to tender your shares from the start.
Indeed. The other new deal we saw this week was the Doctors Company, a medical malpractice insurance company that is buying Pro Assurance, a specialty insurance company that also includes medical liability and workers' comp. So they're buying this company for $1.3 billion or $25 per share in cash. Why is the closing date for this deal expected to be in the first half of 2026? It mostly has to do with the overlap of business and also because insurance regulators have to approve the deal, sometimes in each state that the company has business in. So the spread is almost 8%, but the annualized spread works out only 6.25% because of how long they think this deal is going to take before it closes.
Hopefully, it eventually comes through, though. It's always nice to see these acquisitions close, especially in a more difficult M&A environment. The third new deal announced this week is Paratech Pharmaceuticals, which wants to acquire Optinos in a $330 million deal valued around $9 per share, with a potential CVR payout of $5 per share. The stock last week closed at $9.15, so the CVR is being valued at a very, very low or very, very much of a discount.
Which, as you often see with CVRs, seems to be the case, and which is why we tend to call them free lottery tickets in most cases. Switching over to spin-offs, there's only one that we want to primarily discuss this week, and that was Comcast announcing that David Novak will serve as the chairman of the board for the new SpinCo, its upcoming spin-off of a select media brands and digital businesses.
Right, so Mr. Novak previously served as the co founder, chairman, and CEO of Yum Brands, which is one of the most recognizable companies. Specifically, I recognize it because we used to see insider purchases at Yum Brands China quite frequently.
Yep, we used to see it quite often, and it's interesting that KFC was so popular in China. I don't think they're growing quite as fast as they used to when we saw those insider purchases.
So well timed back then. Interesting to see that growth has slowed now. But going back to Mr. Novak himself, he's bringing nearly 40 years of experience leading and growing well-known consumer brands to the company's new board. And speaking of that new company, Comcast spinoff, or the media spinoff, will be a leading independent publicly traded company comprised of well-known brands including USA Network and CNBC, along with complementary digital assets such as Fandango, Rotten Tomatoes, Golf Now, and Sports Engine, and that was actually surprising to me because I didn't know that Comcast owned Rotten Tomatoes.
Yeah, they went on a massive acquisition binge on media properties a long time ago. And I think over time they realized that the original cable business was the better business with better margins. And it makes sense that they're spinning these off. I was surprised because of how strong some of these brands are. So, not necessarily USA networks, but CNBC and something like Rotten Tomatoes, they're quite relevant even now, despite things like Fandango and USA networks falling behind. Let's switch gears a little bit now and let's talk about stock buybacks. This week was fairly heavy in the buyback world of things. The management consulting firm Huron Consulting Group announced a $200 million buyback this week, representing almost 8% of the market cap at announcement. The company has frequently bought back stock, repurchasing 15% of all their shares outstanding in the last 4 years. So I was looking at the company's financials, and there was a nice inflection point in the business starting in 2021 and 2022. And I was curious to see if they had a management change at around that time that caused the business to inflect. And that was exactly the case. So that was when the company announced that their chief operating officer, Mark Hussey, was taking over the role of CEO. And you could see that the company started doing very well shortly after that.
Yes, the former CEO, James Roth, had been with the company for over 13 years, so it was a little bit shocking to see such a long-standing CEO be replaced, though Mark Hussey had also been with Huron since 2011, so also very much experienced, and he had previously served as a CFO of the company. So he went from CFO to COO to CEO. So nice little,
Wow.
yeah, exactly. It's quite impressive. Now, so this management transition, as we mentioned, seemed to have sparked new growth at the company. The stock is up about 48% in the last year and is up 238% in the last 5 years. The business also scores very, very well on our IA quant model, standing strong with this score about 83. So impressive all around, for sure.
And that's interesting that after such a big run up, they still want to do a buyback that is 8% of the market cap. You normally don't see that. You see people wanting to buy stock or buying back their own stock after the stock has dropped a lot. This is showing some confidence in the strength of the company going forward as well.
Yeah, it's interesting. I think the one thing insider purchases and buyback announcements have in common is that they come after a large drop in the stock price. So this is definitely going against the norm.
Indeed.
Okay, so moving on, I have to say I'm a pretty big fan of avocados, even though I'm technically allergic to them. So it's quite interesting, but you always want what you can't have, and I love avocados. But speaking of avocados, I was quite overjoyed or happy to see that the avocado grower Calivore Growers announced a $25 million buyback, which represented about 6% of their market cap at announcement.
So, one of the issues I have with food companies is they usually tend to be unprofitable or they have tiny margins and trade at very low PE multiples, which they make them value traps. In this case, it's no different with Caliber Growers also being unprofitable since 2020 on a yearly basis, but showing profits in certain quarters. The company did recently flip to having net cash on the balance sheet, and given the somewhat cheap forward PE of 13.2 compared to the trailing 12-month PE of around 30, using the extra capital for a buyback does make some sense.
So moving along to yet another buyback, just bear in mind this has been a very buyback heavy week for some reason. Tencent Music, the Chinese music entertainment company, just announced a $1 billion buyback, which represents about 4% of its market cap.
It was nice to see that Tencent actually was buying back their stock as well. So they bought back around 7% of their shares outstanding over the last 4 years using the net cash of about $3 billion that they have on the balance sheet. So I always like to go back and check and see if a company makes a large announcement, a buyback announcement, are they actually following through and reducing shares outstanding? And this seems to be the case for Tencent.
Coming back to Tencent, the company's market cap is around $22 billion, and free cash flow is greater than earnings, which makes the high IA score of 82 pretty unsurprising. That means it's also a pretty nice usage of capital, which is interesting for sure, putting that extra cash flow generated or the net cash on the balance sheet towards buying back shares and returning value to shareholders.
Indeed. In our last episode, we talked about how American Eagle Outfitters decided to buy back $500 million worth of shares, representing a whopping 26% of their market cap. This week, the company decided to accelerate a part of the 50 million share repurchase program, or around 18 million shares, or $200 million.
Continuing on, Ollie's Bargain Outlet, another retailer, announced a $300 million share repurchase program representing about 4.5% of their market cap. And like we talked about, what's important is to see that if a company's announcing buybacks, are they actually following through? Well, Ollie's Bargain Outlet has. They've previously purchased about 6% of all shares outstanding over the last 4 years. The company is quite expensive at 30 times forward PE, the stock was up about 35% in the last year, which is why the timing of this buyback is quite peculiar. Unlike their customers, though, this might not actually be a bargain for investors considering the high price, the run up in the stock price, and then buying back shares at this elevated price.
I don't know about you, but I'd never heard of Ollie's Bargain Outlet, but just the name makes me want to go check it out, either online or if I can find a store nearby. We're going to wrap up the stock buyback section of our podcast with Oxford Lane Capital, which is a closed-end fund that announced a $150 million buyback. The company also pays a very high dividend of almost 23%. So this additional way of returning value to shareholders is quite interesting to see. And I like to see insider buying, more like buybacks in closed-end funds, because if the closed-end fund is trading at a significant discount to NAV, one way for the company to close that discount is by buying back stock.
Now that we're done talking about companies repurchasing their own shares, we typically move to insiders who are purchasing shares of the companies that they are insiders of. But this week, we're actually going to talk about an insider sale. Leon Black, the co founder and former CEO of Apollo, sold about $71 million worth of stock last week.
Apollo is down 14% year to date, but is still up 500% over the last 5 years, just like most PE firms. And like you and I were talking about earlier today, KKR has been down quite a bit this year as well. This sale was not through a 10b5-1 plan, and he sold significantly more stock in December 2024, which means his timing in selling right before the drop this week or this year was impeccable.
It's also the co-founder and former CEO of the business, so he's a deep understanding of the business, which likely contributed to his very accurate timing of these sales. Moving over from insiders to activists, we tend to talk about Elliott quite frequently in these podcast episodes when discussing activist activity. We pretty much joke about that every time. But that's why I was surprised to see that it was not Elliott, but Starboard Value taking a stand against the 3D design and software company Autodesk this week.
Yeah, Starboard Value took a $500 million stake in the company and announced plans to nominate a minority slate of director candidates ahead of the company's upcoming annual meeting. This move follows a presentation Starboard made in August 2024, highlighting various issues with Autodesk, including missed investor day targets, subpar profitability, and possibly the most concerning of them all, misleading shareholders in order to meet financial targets.
Yeah, misleading shareholders is a very big claim, and that last point is largely tied to an announcement that Autodesk made last year when they revealed the board's audit committee had launched an investigation of the company's internal accounting practices, specifically misreporting and manipulation tied to free cash flow and non-GAAP operating margins.
Autodesk responded by noting that they had proactively met with Starboard representatives over the past year and repeatedly invited them to present their ideas to the full board. When adding their newest directors in December 2024, including John Cahill, the former chairman and CEO of Kraft Foods, and Ram Krishnan, the COO and EVP of Emerson's, Autodesk noted that they had reached out in advance to offer Starboard the opportunity to participate in the process, which they dismissed. This whole thing is very strange to me because Starboard Value usually prefers to work with the companies that they're involved with, and it doesn't necessarily get contentious, which seems to be the case here.
Autodesk concluded their statement in response to this by stating if Starboard proceeds with their director slate nomination, the board's corporate governance committee will review their candidates as part of the regular director evaluation process. So that's a lot of words to basically say no special consideration or changes will be made for Starboard. Their director slate will have to go through the typical nomination process as is expected of any director nomination. Actually, a quick note about the Ram Krishnan nomination. I found that interesting because he comes over from Emerson, and we've actually talked about Emerson quite a few times on this podcast in prior episodes because they just closed their acquisition of Aspen Technology. And remind me again, who was blocking that acquisition?
It was your favorite firm, Elliott, that was hoping to get a higher
Exactly.
price. Right.
Exactly. So I think at the end of the day, everything does come back to Elliot in some way or another on this podcast. That all being said, as I always like to say, let's transition over to C suite transitions. The home building and land development company Green Brick Partners just saw its CFO, Richard A. Costello, depart suddenly, resigning on March 17th with a resignation effective immediately. Mr. Costello had been with the company for over a decade. The stock was up 600% during his tenure. In fact, despite the recent pullback in performance over the last year, Greenbrick is up a whopping 800% over the last 5 years, which is why this sudden departure came as a pretty large surprise.
The strong stock performance is easily reflected in the company's financials, demonstrating very strong revenue and net income growth and a balance sheet that recently flipped to having net cash. Despite the run up, the company still appears pretty cheap as well, trading at a PE of just 6.8. One of the reasons it's trading at a low PE is home builders are considered to be cyclical companies. And the last few years have been very favorable for new home builders because existing home builders, or rather existing home owners, not home builders, were not willing to sell their homes where they had locked in very low interest rates. I still remember that several years ago, a subscriber had mentioned Green Brick Partners to me as a potential opportunity. And had I listened to him, I would have probably been up about 500% as well, because the company did very well under the old CFO.
And that wraps up episode 11 of the Special Situations Report with a little bit of a different conversational twist to it this time. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, despite it being a little rough around the edges as we play around with this new format, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.